In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcasts, type in Old Dogs, spelled D-A-W-G-S, find our podcast, and subscribe. Well, we have a returning guest today. I'm really stoked and excited about. This is a gentleman who has just been killing it in the crowdfunding area of real estate. I mean, this has been a while since he's been on, and a lot has happened since then. So I'm looking forward to hearing about it. I'm talking about Adam Hooper. He is the founder and CEO of RealCrowd, an online real estate equity marketplace that has brought its members access to $7.5 billion of investment opportunities. Founded in 2013, RealCrowd is a Y Combinator-backed company that has grown to be a leader in the real estate crowdfunding space. RealCrowd operates as a direct investment marketplace where investors participate directly in the underlying asset rather than a platform-sponsored entity. This benefits investors by increasing efficiency, transparency, and most importantly, reducing fees and layers of middlemen. He recently launched RealCrowd, a subsidiary platform that is a registered investment advisor where they help other RIAs get their clients access to private real estate investments. Prior to founding RealCrowd, Adam was a partner at a leading real estate capital markets firm where he was involved in over $1 billion of transactions, sourcing and structuring joint venture equity investments. In the commercial real estate business since 2004, he has been involved in launching 3 prior national platforms for investment sales and brokerage, as well as institutional joint venture equity investments. Well, Adam, welcome back to the Old Dogs REI Network.
Thank you, Bill. Happy to be here. That was a mouthful. And for listeners, I will say, I remember last time I was so impressed with the read-in. I think you got one of the best in the biz doing a live read-in. So thank you for that wonderful introduction.
Oh, well, my pleasure. It's very impressive what you've done and what you're continuing to do. And I thought maybe, before we launch into our topic here, maybe you could just kind of give us an update on, what you've been doing since we last talked and maybe, some insights into the industry.
Yeah, we've been keeping busy. It's been an interesting 12 to 14 months, obviously with the COVID crisis and everything that came along with that. From the marketplace perspective, we've stuck to our model there, still operate as a direct marketplace. So as an investor, you're getting to build a direct relationship with the real estate manager, which we felt from day one is super important when you're investing with a partner, to have that direct connection with the manager and have your investment be in the underlying asset itself. So we've stuck to that model. During the crisis, we saw Q2 of last year was brutal, right? A lot of our business revolves around transaction activity, and the transaction markets just basically put a halt. So Q2 was pretty bad last year. Starting mid to late summer, we saw some signs of recovery. We did a lot of multifamily assets. I think that's one of the asset classes that has certainly held up far better than others in the space. And even, this time last year, I don't think anybody would have predicted that we'd see pricing continue as strong in the multifamily asset class as we've seen, since the beginning of the crisis last year. Industrial, similar. Industrial has remained as hot as it's ever been. And I think that's just a trend as we look towards retail moving towards more e-commerce and having to figure out that last mile distribution bit. I don't think industrial is going to become any less attractive. Some of the other asset classes, we paused hospitality deals. We've done a couple kind of core grocery anchored national retailers, retail investments on the more kind of lower risk side of the spectrum. And then office is still a question mark, right? I think that's one that everyone has tried to figure out. What does that look like as we get back, right? We're recording this in May here of 2021. Vaccines are going, things are starting to open back up, people are returning to the office. We're not sure exactly how that asset class is going to play out in terms of what the demand is going to look like or what those reopening plans are going to shape up to be. So that's one that we've still got some question marks around. But all in all, I think we've been saying this for, probably the last 6 years, right? There's this sense of kind of cautious optimism. I would say that maybe got shaken up a little bit last year, that there wasn't maybe as much optimism, but I think we've come through this in a spot where most of the managers that we're speaking with, they're excited. They're hopeful about what this recovery looks like. They're ready to get back into the deal flow, get it, rolling up the sleeves and doing deals. So I think we're in a pretty good spot. Obviously there's still a bunch of uncertainty, and we'll talk a little bit about that with the risk work that we're doing going forward. But conversations seem to be back to that relatively cautiously optimistic tone, I would say.
God, that's great. Well, I know that the residential market has just seeing an amazing boom going on right now. I mean, it's crazy what's going on. It's a frenzy, as far as single family homes out there right now. But I was kind of curious, you mentioned some of the asset classes that you're really seeing some change in. I was kind of curious about that. Are you seeing any kind of repurposing of office or retail or the hospitality area? Where you're seeing projects come in where people are trying to, convert something into a different type of asset class?
Yeah, we've seen some of that in the retail space and what will stick beyond this phase that we're in right now. And so if you look at retail, one of the trends is this kind of switch towards selling goods to selling services in the retail environment. So that would be medical uses is a big one in the retail space, right? So seeing more of this distributed web of urgent care centers and even primary care centers, kind of fitting into what used to be a shop where you would go purchase goods. Now you're getting a service, right? That's typically a little bit more recession resistant, kind of a retail use. So I think that's one thing that we've seen in terms of repurposing is just the shift of use with retail. And then we've seen a couple of managers in the hospitality space buying hotels and converting them to multifamily, right? Because the construction costs right now are just skyrocketing. Land and the just process of developing new product is so costly and time intense right now. We've seen some interesting adaptive reuse or repurposing of extended stay hotels actually being converted to apartment units, which I think is a super interesting kind of reuse.
Wow.
I don't know that we've seen much office repurposing into multifamily yet or anything along those lines. But I think that those are two of the more, interesting repurposing or changes of use that we've seen in the space over the last, 12, 13 months since the start of this.
Wow. Well, it sounds like you've kept busy. Did you have to close down your headquarters for a while and work remotely?
We did, yeah. So we went full remote in, first couple of weeks of March last year, which was, I think easier for us. We were already somewhat distributed. That's the benefit of being a technology company is we're used to having, somewhat remote distributed team already. So that wasn't too challenging. Converting to the remote work, I think it's more anytime you're not in that physical space, it's more challenging to make sure that everybody's rowing in the same direction, right? How do you keep that theme or that consistent push in the same direction when you're not actually in the space with people? So I think culturally that was a a challenge that a lot of companies faced was when you're not sharing a physical space with someone, how do you make sure that you're on the same page with a lot of these things? That just really comes down to communication. I think that's something that, Zoom meetings and all these different tools that were at the beginning that we kind of put in place to help make sure that we're able to have that consistent communication really helped us push through that and gave us the downtime to really focus on. I think that that the silver lining of having a slowdown in the marketplace and the transaction side was it allowed us to really take a step back and you think about what do we want this to look like coming out of the crisis, right? Where do we want to be as a company? What do we want to be in 3 to 5 years? And how can we take this time that we're not running at 100, pushing on the marketplace? How can we maybe refocus some priorities and pull on some things that we wanted to do for a while? But then you have to get everybody on board around that new goal and communicate that remotely, which was a challenge, but I think we got through it and excited to see what we can do here in 21 and beyond.
It sounds like where you were talking earlier is that people are coming back to your office, right? And you're trying to reestablish the previous culture.
Yeah. So we're still remote. We haven't opened up our office yet. I mean, I've been coming up to the office a few times just because it's harder to schedule calls and podcasts around beginning band practice in the house. so that's been
barking dogs or whatever.
Yeah, that's been a change. I know we certainly didn't intend to have 5 people working in our house when we bought it a couple of years ago. So I've been coming back up to the office a couple of days a week just to kind of get some quiet time and get back into focus. But I think generally as an economy, right, I think we're starting to see some signs of life coming back into the office environment. Some of the downtowns becoming a little bit more vibrant, seeing more people down there. But individual companies, they all have different office opening plans. It's something we're still trying to figure out how that looks going forward. But I would say, probably midsummer, later summer, I think we'll see some return, right? I don't think it's going to be a permanent shift to the remote work from home. I think how we'll use the office space will change a little bit. I think it'll be more for collaborative work, just kind of team-based activities. I think there's still going to be a spot for most companies to be flexible with what that looks like, though, and having the ability to do some remote work and work from home for some of those more kind of focused periods, I think is something that we're certainly going to support. And I think we'll see a lot of in other industries too, where it'll be more of a hybrid nature, right? It's not going to be you're in the office from 8 to 5, Monday to Friday. Maybe you're in the office 2 days a week, 3 days a week for more of the collaborative planning and team-based work. And then you're going to be remote for some of the solo-focused work outside of that. So I don't know. It's an interesting dynamic. We'll see how it shakes out. But I think there's generally Zoom fatigue and work from home fatigue, I think, are real things. And so I know there's a fair number of people that we speak with that they're itching to get back out in the world and maybe even start doing some travel later this summer.
Yeah, that's true. Well, thanks for that update. There's it's interesting you talk about, multifamily is still going gangbusters too, and that I know is a big part of your platform. But there's still that question. What are the risks that are involved right now? And as an investor myself, I'm looking at different asset classes. I'm looking at dynamics within the economy that are happening right now. I mean, some people say we're entering into a bubble or we're already in a bubble as far as the single family market is concerned. One of the reasons we wanted to talk here today is really to kind of examine some of those risk factors. You get the opportunity to see so many different aspects of the marketplace, and so I would really like to get your insight into the various risks and what we need to be aware of.
Yeah, and so this is really the driving force behind our new platform that we just launched called RealCrowd, and it was really born from a couple of things. First, behavior that we were seeing on the marketplace, where we saw a lot of this kind of returns-based investing, where they would come on the marketplace and they would put their money into the highest yield deals, right, whether it's an IRR, equity multiple, without a real appreciation of the risk that they were taking to get to those returns, which we've tried to combat throughout the history of our company with our podcast and educational content and materials that we have given to investors to try to help them make better decisions, investment decisions. And then we had a number of investment advisors that were using our platform for their personal capital, but they couldn't invest their clients' capital in the deals because, as a fiduciary, they're not real estate experts themselves to the extent that they could recommend those investments to their clients. And so we saw the opportunity, and this is something I've wanted to do since very early of starting this company, was how do we figure out which deals are better for what people, right? There are some deals that are just patently bad and no one should invest in them. And then there's other deals that are better for you than they might be for me based on our goals or what our risk tolerance is. And so to do that, we realized that we have to have this objective kind of universal language of risk so we can understand the risk that we're taking in a portfolio and then build an appropriate portfolio of risk for that individual person. And so it's kind of taking a step back and trying to change how you think about these investment decisions and looking at it through a lens of, am I taking the right amount of risk from my portfolio rather than am I chasing the right kind of returns for my goals, right? So it's really a shift in a fundamental analysis of how we look at real estate. And to do that, we formed a subsidiary, Reallocate Advisors LLC, registered it with the SEC as an investment advisor, so that we can actually help people build those portfolios and really ground it in this risk. And so when we survey the landscape, this was, 18 to 24 months in process of building out this methodology and this concept of looking at risk like we do, trying to distill the universe of all these risks down into an approachable subset of categories. And so the 5 that we ended up on are the market, the manager, the physical asset itself, how the investment is capitalized, and the partnership structure. And so when you're investing, and again, this is different than if you're purchasing an asset on your own account, right? This would be if you're investing in a syndication or as a limited partner with another manager. Across those 5 factors of risk, there's a number of different metrics that we can quantify, right? We can look at historical data. We can quantify those different measures of risk and then figure out how much risk are you objectively taking in that investment. And so that's kind of the setup of how we got into this conversation about risk is how do we objectively quantify the risk so that we know how much risk you're actually taking and then build a portfolio around that. So that was conceptually where we started with this, and happy to dig into each of those 5 and talk a little bit about some of the factors that we look at, some of the considerations as an investor. Right now, we're still focused on multifamily within this methodology. We're going to be building out industrial and office soon here. But right now, risk model is focused on multifamily. Again, that's the most robust asset class that we've seen throughout the crisis, and one that we think still has a lot of really good tailwinds behind it of where that asset class is going to go as a long-term investment right now.
That's great. Now, as you're looking, now this is a portal, I would assume, for existing clients, or can anybody come in and access this information? How exactly is that going to work? Is it going to be sort of a membership or subscription-based service?
Yeah, so on the Reallocate side, as you mentioned at the top, we're working only with other RIAs. And so real estate, we know it's a component of someone's portfolio. And our alignment is to make the best help those clients make the best investment decisions. Is we need to understand the context of the rest of their portfolio as well, right? Making decisions for your real estate allocations just in a vacuum without any consideration for what the rest of your holdings are, what the rest of your goals might be. That's very narrowly focused on just a portion of it. So we actually only work with other registered investment advisors. So we have a partnership with one. If someone doesn't have an advisor they're working with, they can go to buildmyroadmap.com. We have a partnership with one of the largest wealth managers in the country, Mariner Wealth Advisors. You can get signed up with them, and we can offer the services through them. Or if you're working with a wealth manager and RIA currently, we can engage with them as a sub-advisor. So we'll basically work with that primary advisor, understand the client's needs, understand what their portfolio looks like, agree to a risk strategy and a total allocation, and then we'll make the recommendations kind of within that framework through the help of that primary investment advisor. Got
it. Now you mentioned the first factor was market, right?
That's right.
That you're going to look at. What kind of an assessment is made regarding risk in a given market?
Yeah, so market, a lot of that is going to be driven by jobs, employment data, population growth. In the market, we look at things like the existing supply, right? What is the construction pipeline looking like? And, one of the things that we've seen as we were going through this health crisis, right? We started the model long before COVID hit, and trying to figure out with all the markets, I mean, they've all been hit pretty substantially, right? Some more than others in terms of the employment trends, and trying to think, do we need to make any adjustments to this? Did we build a model that can accommodate for these different trends in the employment and the job loss that we saw? And it actually held up. The thought process that we were coming at before the crisis held up through it, right? And I think what we've seen is a lot of the markets that we've put through this analysis have an elevated risk score, and that's to be expected because we've seen tremendous job loss. We've started to see some acceleration in job growth in certain markets. Some of the markets that are more knowledge-based, that are more kind of technology-focused, those have come back, and those have started to show some good signs of increasing job growth. But before the pandemic hit, so again, markets, a lot of employment statistics. What's the nature of that employment? What's the concentration of employment? How well diversified is that employment? And really trying to get a base for what is that foundation of the employment look like, and what is that population that's either coming or going from that market, right? We've seen a lot of the kind of coastal urban markets, some exodus from there, moving out to the suburbs. The Sunbelt states have certainly continued to see a lot of growth, a lot of migration out from California and from New York going south. So trying to keep in tune with what are those, that's more of a demand driver, right? What does the demand look like that for those assets in those markets from a person and employment perspective? That's a lot of the stuff that we look at in the market.
Got it. Yeah, well, I'd be really curious as to sort of how that would take place. So do you start with an actual property, or do you you look at the various factors based on where your risk tolerance is, and it points you to a market or points you to an area of investment?
Yeah, that's a great question. So for us, and this segues into the second factor, which is the manager. It always starts with the manager. So a lot of our process, even on the marketplace side, is manager driven. And when you're investing as a passive investor, right, not buying something necessarily on your own account, when you're investing with a manager, that is the most important factor in the project, right? They're the ones that are finding the investments, sourcing it, structuring the deal, finding the capitalization for it, doing the actual work at the asset level. And so a lot of our work is centered around the manager. And when we look at the manager from a risk perspective, it's full review of their entire track record, right? How many properties did they buy? When did they buy them? What did they buy them for? What kind of assets were they? What was the strategy? And a lot of how does their historical body of work compare to this investment that they're looking at doing now? So if you have a manager that's, they've owned and operated $1 billion worth of industrial real estate, but now they're going to go try to build an apartment complex, that's probably a little bit more risky than if they're going to build another industrial building, right? So looking at how their experience historically is compared to this investment that they're currently working on. And then we'll get engaged typically after that manager has identified a property, once they have it under contract or they're doing their due diligence and trying to figure out what the capital stack looks like. That's usually when we'll get engaged. We'll have done our work on them as the manager. They'll have gone through our approval process. We'll have their risk score pretty well nailed by that point. And then we'll start with that investment. And then we'll look at those different factors like in the market and the capitalization and the partnership structure, in addition to their qualifications and their background and strength as a manager.
Okay. So collect that information for you, or are you going to third party and doing your own data collection?
It's a bit of both. So some of it will be supplied by the manager. A lot of it, though, is information that we're collecting either from public available data sources or different data subscription services that we have. Like for background checks, we use Thomson Reuters Clear, right? That will pull all their information, history, litigations, foreclosures, bankruptcies, all that stuff on the manager side. We'll run that through some different data sources that we use. So it's a combination of data that's supplied by the manager in their process, right? They have their pro forma, they've got their financial model for the investment and what that strategy looks like. So we'll take that, we'll consider that in, we'll use some of those numbers, we'll add some of our own and do our own analysis on it. And it's kind of a blend of work that we're doing outside of what we're provided by the manager, but also then confirming and verifying information that they're providing to us as well.
Great. And each category, each factor has its own sort of risk score, or is it just that's just a cumulative score of an entire project?
Yeah. So we break it out in factors, and then we run it through kind of a final algorithm to come up with a blended score across the core to opportunistic plus spectrum, right? So our industry has often talked about strategies, risk strategies as core plus, value add, opportunistic. And what does that mean historically? Well, if we're going to buy an apartment building at 85% occupied and we'll spend $12,000 or $13,000 a unit to renovate, we'll target a 17% IRR, so we'll call it value add, right? That's maybe about as scientific, well, maybe a little bit more scientific than that. But a lot of it was just this kind of general strategy around a business plan and a target return would kind of identify the risk. And that really wasn't, we felt that it was hard to have a risk-adjusted return conversation if you don't really know how much risk you're taking. And so that was a lot of the foundation of we need to figure out where on that x-axis of risk, where do we fall on that? And then what would be an expected return based on how much risk you're taking. And so we look at these individual factors. Again, there's 350 plus different individual components that we look at grouped underneath those 5 major factors.
Wow.
And then we kind of pull that into an aggregate score of where it falls from that core to opportunistic spectrum. And that's kind of then the final investment opportunity ranking that considers all of those factors. And then from there, we'll build a portfolio with that risk classification of that investment opportunity.
Well, you, I would imagine, have already just a great deal of data. I mean, you've been around since 2013 of various projects and, managers and so forth that is in your own database. Do you use that as a reference in this assessment?
We do, yeah. So we'll back test it against deals that we've seen on the platform historically. The real estate space it's becoming, data in our industry is certainly becoming far more available than it was 7 years ago, right? That's still something, on the marketplace side, when a manager makes a general solicitation, which is how the marketplace functions, right? These are managers that don't necessarily have a pre-existing relationship with investors on the marketplace. So it's from the SEC's perspective, it's a general solicitation. Where historically all that information was held very close to the chest, right? As a real estate manager, your data was your secret sauce, right? If you knew something that somebody else didn't know, that's your value, right? That's how you could find assets that are mispriced. And so just the transparency that we've seen, even on our own platform over the last 7 years, that's really uncomfortable for a lot of real estate managers, is to be that transparent with their underwriting and with how they look at deals. And so generally, I would say data is becoming far more available. Obviously, we would love to have 10 times the amount of data that we have to be able to analyze and look at different scenarios and run more historical models against these. But we're getting there as an industry. I think it's certainly, we're catching up to some of the other financial service. We're catching up to some of the other technology industries where big data truly is big data. I don't know that we're there yet in the real estate space. From a, quote, I'm making air quotes here, which is hard to convey on a podcast. You don't think we're quite at the big data space yet in the real estate industry. Who knows? Maybe we'll get there, right? I think some of the interesting things that we're seeing, when you look at like smart buildings, right? Internet of Things and connectivity and sensors that are all around us, trying to gain some insights from that, I think, is a really interesting direction that our industry is going. How can we leverage non-traditional data sources to make better investment decisions and help that, have that help inform our view on what makes a investment more or less risky, I think is really interesting. Still kind of at the early stages of that, though, from a true, big data perspective in the real estate space, I think.
Yeah, well, I would imagine just the data that you've just spoken about, that you have a lot more data than most investors have access to. You generally they're
Mhm.
a big part of their focus is they look at the the plan that's presented, the pro forma, but then they spend most of their time on the sponsors and the
Mhm.
the managers and just try to grab what they can in terms of information. So I think already it sounds like you have a much more in terms of data, you just have a much more very I don't know, just I would think more data to draw from that help them to make good decisions.
Yeah, and we see a lot of interesting data from managers and some of the backgrounds and some of the things that we find. Yeah, we see some interesting stuff, that's for sure. But yeah, to be able to pull from, we'll have closed our 300th deal here. I think this week, the next one that we close will be our 300th deal. So it's a lot of real estate that's been through the platform that we can pull off that experience and with that track records of managers and performance of their deals. So it's definitely gives us a bit of a head start that we're hoping to be able to help make sense of and communicate that to folks that maybe don't have that same access to data, right? We can help make that easier for them to figure out which investments are right for their portfolio.
Great. Well, let's look at some of the other factors. We talked about market and manager. What was the next one you had mentioned?
Yeah, so next one would be the asset, right? The physical asset itself. Um, how old is a building? When was it last renovated? We look at trying to get to maybe the business plan of the asset, right? How much are you trying to grow your net operating income until you get to stabilized? That can be an indication of the business strategy, right? If you're buying something that's already stabilized, you'll probably grow rents at inflationary 2 to 3% per year in your underwriting. That's going to be substantially less risk than if you're growing something at 7 to 10% per year in rent growth. So trying to get to some of the business strategy there, what's the capital improvements that are going to be required, deferred maintenance, if we can do replacement cost or appraised value, what is the acquisition to some of those other benchmarks of really giving us a picture of risk is there in the physical asset itself, both from a strategy perspective and then also, again, looking at the property condition reports and all those different aspects within the physical structure of that investment.
Yeah, that seems like that might be a little challenging at times because they're, and again, it depends on your algorithm, I'm sure. But you have sometimes these areas like Chicago where there's just a lot of old buildings, and or other areas where you have the similar thing in San Francisco, even, and a lot of rehab people can just gut them and just put all new everything in there, and but it's still a building built in 1900 or 1925 or something, and comparing that to something that was born, that was built in the 80s or 90s or something, a little bit newer. I imagine it's kind of, I don't know, it's hard. It's like apples to oranges in a certain regard.
Yeah, I mean, I think that's where some of the common sense comes in, right? Buying a building that was built in 1908 and doing a total gut renovation rehab is probably going to be more risky than buying something of the early 2000s vintage and doing a little, light surface renovation, right? Light value add. And those are the kind of things that we're trying to tease out when we look at risk, right? Objectively, which of those is riskier, right? The 1908 seismic issues, engineering, HVAC, fire life safety issues, plumbing, heating, electrical, right? Those are all elements that add a lot more risk, and they also add more emphasis on the manager too, right? That's the other, how these risk factors interplay with one another is also super interesting. When you have these ground up developments or heavier value add projects, there's a heavier reliance on the manager and on their skill set and what does their track record look like in executing investments like that versus something that's a little bit more stabilized, or certainly, when you get outside of the multifamily, if we look at maybe a single tenant net lease asset, right? A 25-year absolute net lease to Walgreens. There's not a lot of heavy lifting in that investment, right? You just kind of sit back and you collect your checks. That's going to be less manager risk than something that's going to be, a ground up redevelopment or ground up development or one of those heavier repositionings like you brought up with some of those older vintage product.
Now, has your platform done any or taken on projects that were in opportunity zones?
We've done a handful, so not on the advisory side. We've done a handful of them on the marketplace. That's one area that I would have anticipated seeing more activity than what actually materialized. Early days of opportunity zones, everybody and their brother announced that they were raising a $250 million or $500 million or $2 billion opportunity fund. So there was a lot of people that were looking for opportunity zone money, but not a ton of opportunity zone money that was out there to deploy. I don't know that we saw as much activity in that space as we had anticipated early days with how attractive those incentives really are from a tax perspective. But then you had to think about, what is that Venn diagram of people that have capital gains to invest and are okay investing for 10 plus years in a incredibly illiquid investment with a lot of times much more value add, right? Again, not a lot of cash flow. Most of it was development, had to be, because you had the basis, the basis, you had to reinvest basically 100% of your acquisition basis, save for a couple circumstances. So you had to have a pretty heavy value add approach to it. And I think that crossover of investors that had those capital gains and those that were willing to lock up their money for that period of time, that was a pretty small crossover from what we saw. So I would say that was one of the areas that we probably had higher hopes for than what actually materialized in the space. I'm curious. I don't know if you've seen much in your conversations or in your experience, if you saw that really play out as robustly as I guess we would have expected it earlier on.
Yeah, we've had a number of folks on that have done projects in opportunity zones, but it's like you said, I expect to see a lot more because especially when they opened it up nationwide, it was just, man, they were all over the place. I don't know if the regulations and the requirements were so tight that it was difficult to do. I don't know how the funding side of it was happening, whether agency money was involved, but I did not see as much as well as I expected, because I thought, people would be all over this, but I don't know what attributed, why that's happened.
Yeah, I think there was some uncertainty around the regulations early on, right? There were a couple rounds of revisions that they certainly weren't entirely clear mechanically how it would work. And I think, investors and managers were maybe taking the wrong approach in the sense that they thought that maybe this tax incentive could, it's not going to make a bad deal good, but it can make a good deal that much better, right? I think that's certainly how we looked at it. Was it can make a fundamentally good deal that pencils without that tax treatment. It can make it that much more attractive, but it's very rarely would that make a deal that wouldn't pencil otherwise, a deal that somebody should do. And I think maybe the managers were looking at it as this was the savior for that project that they maybe couldn't get off the ground before, for some reason independent of that this tax incentive would maybe kick that into something that was going to be super attractive because of this tax treatment. And I'd say it's something that we've seen in the marketplace time and time again, right? Investors are smarter than I think a lot of people give them credit for. They're a sophisticated crew, and you can't really let the tax tail wag the dog, right? You gotta kind of pulling in the old dog's theme there. I think looking at it through a fundamental investment lens, I think that's certainly how we would look at investing in opportunity zone projects and have recommended people look at investing in opportunity zone projects. Still sticking, it's a real estate investment decision, right? This tax treatment is another layer on top of it, but it needs to be fundamentally good real estate. It needs to stand out on its own, and then this tax treatment can make it that much better. So I don't know, we'll see. It's still out there. Maybe the tides will shift, but I think that was I'd call it an underperformer from a strategy that we expected to see better from.
Sure. Well, let's look at some of these other risk factors, and then after we go through them, I did want to try to get input from you in terms of what our listeners might be able to draw from those areas, and as you have put this platform together.
Yeah. So the next one would be capitalization. That's a pretty straightforward one. A lot of the kind of traditional financial metrics, loan to value, debt service coverage ratios, debt yields, looking at some of the more financial performance based metrics, not a lot of, anything too crazy there. That's just kind of fundamental financial analysis that we look at. And trying again, like if you look at loan to value, something that's bought all cash or with a 35% loan to value is just inherently less risky from a capitalization perspective than something if you're going to put an 80 or 85% loan to value against it, right? And that's where again some of this common sense comes into play. Of there are just certain things that are riskier than others when you look at how you capitalize a project. How many capital positions are there, right? If you're investing in a senior loan, that's less risk than if you're investing behind a senior, behind a mezz, behind a preferred equity piece, and then your common equity. There's going to be more positions senior to your capital, therefore more risk. So capitalization is pretty straightforward, kind of tried and true financial analysis on that one. Nothing too crazy there.
And the fifth area?
Fifth area is a partnership structure, and that's one, again, not really applicable if you're going to be investing in your own property, right? If you're buying an asset on your own account, but if you're investing with a manager, the partnership structure is pretty crucial, right? I mean, that covers who gets paid what and when. In there, we look at things like what the co-invest is, what's the net co-invest, what the fee structure is, what kind of a promote structure there might be. So really trying to figure out from an investor in this investment, what is your protection or exposure essentially from the partnership structure, and how that cash flow and distributions are going to be treated, both from operating perspective and also from capital events, whether it's a refinance or a sale at the end of the asset investment.
And do you look at, on that particular factor, are you looking at, let's say, if there's multiple GPs, do you run sort of the same kind of analysis on each as you would, one manager or one key sponsor?
Yeah, so that would be in the manager section, right? That's what we're gonna capture if it's a co-GP scenario. Trying to again isolate these factors somewhat from one another. So the partnership structure is really what's in the PPM, right? What are the governing documents that dictate who's entitled to what percentage of cash flow and distributions from capital events, and what is the risk associated with that, right? Looking at what percentage of your returns are coming from cash flow versus appreciation at the end of the investment period, right? That's another indicator of risk. If you're getting 80% of your returns from cash flow, that's going to be lower risk than if you're getting 80% of your returns or 90+% of your returns from this sale event at the end, right? So trying to bring all that in together from how is this investment governed? What are you as a limited investor, limited partner in this investment? What are you entitled to from those cash flows? And how is that all structured with those governing documents, PPM operating agreement? That's what we're trying to capture in that partnership structure section.
Got it. And when you have all this data together for these five major factors, is there a report that's generated? Is there a meeting that happens, or how do you how's that presented to the potential the IRAs that are working with this in terms of it's project oriented, right? So you're looking at a key project.
That's right.
Yeah. And so is there like there's a 1 to 5 scale here and it falls in the 3 category, or do you go through each area first and look at where the strong factors are and where they're not? I'm asking like 50 questions. Sorry.
Yeah.
What do you do with the data? I think is what I should have said.
Yep. Without giving too much away. So it's we look at in those initial meetings with the advisor, we'll come up with a target allocation plan for that client, and that'll kind of set the framework for how we're going to recommend investments to them. And then once we do the work at the investment level, we know how that client's capital needs to be allocated, and where we see deals that fit within that allocation model, we'll make that recommendation to the advisor and provide them with the, with the report, all the underlying material. And the financial advisor and the client, ultimately at the end of the day, they'll have the final decision as to whether or not they agree or they want to invest more or less in that particular deal. But that's a lot of the work that we do behind the scenes is kind of living at this intersection of client risk and real estate risk, setting up that framework and then making those recommendations where we see that overlap and where that, if that investment will get the client closer to their target, then we'll make the recommendation.
Gotcha. Wow, it sounds like an amazing tool, I would think. How far along is it at this point? Are you, have you already started assessing, properties and projects and so forth?
Yeah, we have. So we've done our first couple of deals. One was an apartment building up in Bellevue. Another was another apartment building down in Phoenix. And again, I mentioned our relationship with Mariner Wealth Advisors. We've been doing a lot of work with them to help their clients and their advisors get access for right now, and kind of working in a beta group with some folks there, and looking to really ramp it up and bring some other folks access here as we roll out this year.
That's great. Yeah. And it sounds like it's going to be something to watch. For those that are listening that won't necessarily have access to that, what sort of overall statement can you make in terms of, the guy that's kind of stuck assessing his own projects, with these five major areas? What kind of tips can you give them in terms of, where's the weight there? What are the things you really need to dig deepest into?
Yeah, I mean, they're all important, right? And that's kind of where we ended up where we did, right? I think if you're investing with in a syndication or with another partner, you pick the jockey, not the horse, right? So a lot of it comes back to the manager and asking the right questions, right? Asking the hard questions that maybe people get intimidated to ask, but what is their track record? Have they lost money on deals? And if they did, probe a little bit further, right? What did they do to try to work it out on behalf of the investors? How did they act when they had a deal that was challenging? How well do they communicate that to their investors? And then some of the more fundamental analysis, right? We talked a lot about jobs and population growth and migration data in the market, fundamental, financial analysis, looking at some of those metrics, loan to values, understanding a debt service coverage ratio, looking at some of those kind of, typical key factors of what you'd expect. And then, again, a lot of the real estate space is still relationships and how did you get introduced to someone, how they performed for that person that introduced you in the past. I think a lot of those questions, whether someone's working with a financial advisor themselves and we have the opportunity to work with them, or if they're just analyzing deals that they see from some other network or some, the country club network, right? Being able to think critically about the underlying aspects of the investment, right? Real estate managers, they're their best cheerleaders, right? They're always going to try to tell the rosiest story. But being able to kind of take a step back and dig a couple layers deep and put some of those critical thinking bits into place, to look a layer beneath the story and really figure out what are some of those factors and is there a comfort level? And if you don't understand, ask the questions, right? Real estate managers, if they're a good manager, they will answer your questions. They're in it for the long haul. They appreciate those relationships and they want to make sure that their investors understand, right? They want to make sure that they're on the same page and doing what's right for them as well, because that sets up a long-term relationship for the manager and the investor, and really making sure that alignment is there by asking those questions and not being afraid to do so. I think that's probably number one tip that I could give is don't be afraid to ask those questions.
Well, great information. Well, this has been fascinating. There are so many. I didn't even realize there was something like this that would, take all that data.
That's what's so exciting. We think this is a pretty fundamental shift in how we can look at these investment decisions and something that hasn't really existed in our space yet. And so, we're super excited to keep pushing on it, see how far we can go and really try to change the lens through which we make investment decisions, right? It's you don't get many opportunities to do that, and we're definitely excited to see how far we can push it.
And I mentioned a little bit about third-party data. Do you tap into sources like CoStar and others that just have these dramatic databases on all kinds of information like that? Do you sort of link into that info?
We do, yeah. So CoStar is a big one. Yardi Matrix. There's a lot of Real Capital Analytics. There's some new ones, some new data aggregate out there that are again bringing more insight to what had historically been fairly well locked away real estate information. We're just getting to a stage where the data is available and accessible enough that we can start finding some of those insights in it. Obviously, again, like I said, I wish we had 10 times the amount of data to crunch. We're getting there. It can be expensive, unfortunately, to get access to the data for now. But yeah, all those different data sources, and one of our greatest used tools is the St. Louis Fred. If you just Google St. Louis Fred, they've got a ton of great governmental data in terms of economic data and jobs and some of those financial metrics. That's another huge data source that we leverage. Public data source that we leverage for sure.
That's great. That's a great tip in itself. Thank you. Awesome. Wow. Well, this has been really helpful and some great information for our audience. I'm sure there's people that want to find out more about you and the RealCrowd. What's the best way for folks to find out that information?
Yeah, so RealCrowd, pretty simple, just realcrowd.com. Or again, if you're interested, whether you work with a financial advisor or would like an introduction to one, you can go to buildmyroadmap.com and you can schedule a call on there and we can help set you down the right path.
I love it. Great. Well, Adam, it has been great having you on. I can't thank you enough. I know you're a busy man, but you've shared some great data and also, some good market perspectives too. I know a lot of us are kind of sitting here just kind of wondering what's going to happen, what's ahead here. And I think you gave us some good stuff there to chew on.
Very good. Well, again, I appreciate the opportunity to come back on the show. I'm glad we were able to connect today.
Me too. Me too. It's been a pleasure. And I also want to thank all our old dog listeners out there too for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot. And we really appreciate it. Please note everything that Adam talked about today will be outlined in detail. And I know there's a lot of data there, but and where there are links, we will provide those. And all be accessed in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode with Adam Hooper. That's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.